All right, so I've been in gold for quite a while. Since 1883. I don't mean the year 1883, but I mean since gold was at 1883. It's been a long time, there's been lots of ups and downs, lots of undulations, but where do we see the price going next? After that huge move down that we saw here, where we had the high of 5,600, we saw in a few short days a 22% drop. Now, if you were anything like a long-term holder like me, you were buying those dips with much gusto and alacrity, with the eventual resumption of the trend, seeing what we've seen so far. Now, where do we see the charts going forward? Where do we see the trends going forward? And how can we look at history to maybe inform where we could be going forward? Well, I think although past is not prologue, sometimes it is useful to see how these markets have traded historically in order to see where they could be trading in the future. So in gold's most recent ascents, we've seen gold start a bull market in 2024, maybe even earlier, and the move so far has been up a whopping 117%, depending how you measure it. But if we look more historically into longer term trends of gold, how do they compare? Well, I've taken the liberty of doing a few analyses for previous bull markets. So in 2016, we saw gold rise by 100% in 1600 days, over 54 bars on the weekly candle, on the monthly candle. And if we look even further back, in 2006, we saw gold peak to trough move 316% over 2,000 days. So this market where we are right now, although it looks very parabolic, and I would agree that we are probably in a parabolic up thrust, it doesn't mean we can't continue going up. And I'm positioned as such. Let's see, if we look at the recent bull market as starting from, let's say, 2023, and I think that's even a bit inaccurate to start thinking about it from 2020 to 2023, because I think the real bull market in gold, the most recent one, once it broke out of that long-term consolidation, actually started in 2024, late 2024. So if we go by historical trends, where could our extensions actually be? If we take the average of previous bull markets, we're looking at an average percentage move before it actually materially pulls back to long-term mean reverted averages of up to 230 to 250%, which gives us a gold price of anywhere between $8,000 to $9,000. Now, if you look on the streets, you'll see lots of really lofty estimations of where gold could go. I think JP Morgan might be the most ebullient with 6,500. You have a few 7,000 calls. You have some outliers who are calling for 3,500 gold. But I think the days of us seeing 3,500 gold are long behind us. But if we zoom back into a more immediate point of view, let's get rid of this. And we look at the price action and how it has coincided with just technical trading levels. So when we had that huge down thrust that left many of us shaken and stirred, let's be honest, it abided by the technical behavior that we'd expect in an upward market, almost to a T. I mean, if you were writing the book on how a market should be reacting in terms of long-term behavior, then this was archetypal. This was exemplary. This typified how markets behave in bull markets. So we saw another short-term high around the date of the 25th of October. And many people were calling for the end of the bull market then. And we saw a big movement down as well. How big was that movement down? That movement was in its entirety 11% down, which is not a small move, right? After that huge consolidation period of, I want to say a year, we saw a 30% move up in gold for it to give back 10%, which is quite a big move. But again, it abided by all of these critical levels, all of these levels that we look for in technical analysis. Now, I'm not the hugest fan of like pure technical analysis in terms of, like RSIs and MACDs and all of these other things, but I do look at price action and price behaviors. And I do look at points of control and liquidity gaps in terms of where we're going to fill and where the next movement is going to be. So if we're looking at price structure from a purely indication, correction, and continuation point of view, then it's fit that paradigm perfectly each time. Each time we've seen it, it's happened textbook fashion. So look, we're hugging those EMAs, we're hugging those SMAs, we're hugging those VWAPs and those moving averages, and we're seeing new highs, corrections, new highs, corrections, continuations, new highs, corrections, continuations, new highs, corrections, continuations. A new high, a huge correction, and what looks like now is going to be a continuation. And that really goes in line with a lot of the other corollaries to the gold trade, namely the dollar. Now, a lot of people have said that the dollar and the gold trade is divorced in terms of correlations now, but I still believe that the correlation matrices still abide by reality and trading 101. Now, if we look at the dollar, many people on the street and many experts and analysts have said on a trade weighted basis, the dollar is hugely overvalued. But we have stubbornly been trying to break this level around here for the last 300 days. This level of around 95 to 95.95.3, we've been trying to break that. And I think as soon as we break those levels, we're going to see a real cascade down. But where are we going to see it cascade down to? Well, the natural point for us to see the next level would obviously be down to the next level of support, which I draw at around here, and I also draw it at around here. So that means a DXY trading around 88. What does that mean for the price of gold? Well, that means for the price of gold, we're looking at 6K on gold. Now, if we really do get a Mar-a-Lago Accord, or if we get some kind of new accord that coordinates between central banks around the world, that actually sees the dollar falling off of a cliff, we could reasonably get around to points of control in the low 80s. And for gold, at that point, we are off to the races. We are definitely off to the races in that point. Now, another corollary is obviously going to be the treasury yields. Now, again, treasury yields, let's get rid of these charts. Let's clean these charts up a little bit. Let's get rid of all of those. Now, the treasury yield has been stubbornly hovering around this location in between 5 and 4 for, oh God, the last 1,200 days. So it's been there for a few years. Now, in historical rate cutting cycles, we normally see it falling off of a cliff. And it's better visualized if we look at it on an area chart. So let's look at it like this, and let's elongate the time period and the time zone. And let's look what it really looks like when it goes into a easing cycle, and when we go into more fiscal expansion, fiscal dominance, and fiscal largesse, and people really veering away from treasuries and treasury yields just going down. It doesn't occur just over a long period of time. It tends to occur in a huge downward step fashion. Like, for example, in 1984, when we saw huge moves down, or when we saw in 2007 a methodical move down again. So if we see the 10-year acting similarly to what it did before, we could easily see the 10-year moving to long-term averages of 1.5 to 2%. What does that mean for gold? It can only mean good things for gold if you follow trends and if you follow economics 101 in terms of the opportunity cost for holding gold and real yield assets. Now, what's more interesting is the policy sensitive 2-year bond and the yield here. That really does Unless you're talking about like short-term paper, 1 month, 2 month paper, those kinds of treasuries, then we are looking at the 2 year as the most policy sensitive response mechanism in terms of the value of the dollar and how people are treating the United States in terms of risk, in terms of the supply of treasuries, and in the terms of inflation projections going forward. Now, if we see how the 2 year reacts in times of easing, it is even more precipitous in terms of how it falls when the easing cycle really goes with alacrity and is expeditious. And we see that coinciding with real strong bull markets with gold. Now, if we move on to now, where we are right now, 2026, where is the rate trajectory? Well, if we look at past, and always past is not prologue, but it takes about 600 days for rates to normalize in their range. So a 600-day range, we could see yields on the 2 year going to 2%. What does that mean for gold? Well, it can only mean strong bullish markets for gold. Now, we can look at VIX, we can look at VIX of VIX, we can look at all of these other metrics. But an important one is if we look at gold volatility. Now, looking at gold volatility with our normal traditional candles, that's probably better. So long-term gold volatility has been trading in a range, not too volatile. You wouldn't expect gold to be like a hugely volatile asset ever, but you can see these huge spikes when the price of gold plummets or the price of gold goes up against standard deviations or real sigma events in the price of gold. Now, when we see gold volatility going up, it's a really good time to start positioning. I'm always on the long side of gold, especially in this macro environment with a narrative of fiscal deficits, of fiscal dominance, of profligacy in terms of fiscal incontinence. So when I'm looking at gold volatility, to the upside, I'm looking at it as a position, as a time to buy, essentially. Now, you may also be interested in looking at the seasonality of gold to inform how gold behaves in previous cycles vis-a-vis how we're behaving now. Now, this chart can get pretty messy, but if we're looking at the last, heck with it. Let's look at the last few years of gold. And this really is quite powerful. 2007, 30%. Every single year is actually positive growth, positive momentum, positive returns for gold, except for a few outliers. Now, the few outliers, they tend to be sub 7%, but you can get those years, those cataclysmic years where gold drops off 30%. And I imagine it's after a huge rally that happens. So it's actually dampened and the pressure is quite ameliorated in terms of what it does to the overall performance of your portfolio. The volatility is hard to stomach for sure, but it's suppressed and repressed in certain ways. Now, if we look at it on a percentage basis, then we can see the seasonality a bit clearer. So over here, we can see certain months that seem to be more propitious for gold and months that seem to be less auspicious for gold. So February seems to be a month where we have actually quite tepid performance, but positive performance nonetheless. Again, past is not prologue, and you can extend this all the way out into 1881 if that takes your fancy, and you can see what gold looks like seasonally in all of those times. And I like to look at it because I like to see it as a gauge to where gold is trading in previous cycles versus the super cycle that I truly believe we're in now. Now, my best analog for what I think is going to happen in 2026 is what happened in 2025. And we can see that it kind of tracks that performance already. But seasonality is a good metric to look at. Now, something that you might not hear spoken about a lot is the option side of the gold market. Now, I like to use CME's option tools, and people are rightly bullish on gold. A lot of people are taking out optionality in parts of the gold option chain that seem absolutely insane. So now let's look at this contract right here. Someone is very bullish gold, and it's not me because I don't have that kind of purchasing power. But someone is buying 20,000 strikes of gold that expire in a year. So they're predicting that gold is going to be hitting 20,000, and they're really putting a lot of money behind it. 6 million notional, 6 million to buy these calls, and it's controlling $24 billion notional value of gold. They're going to be in the money if it hits 20,000. I don't know about the deltas and the gammas, whether or not they're going to get in money closer, but someone is very, very bullish on gold all the way up there. Again, someone is very bullish at a 15,000 strike of gold by the end of the year as well. Someone has expressed this by buying 13,000 calls. Remember, each call represents 100 ounces of the metal. And this is again in the range of 20 billion notional value. Someone has spent big amounts of money to take out gold's optionality at 15,000. And we can just see the put call ratios and the put call skews. We can see that the call volume is way higher than the put volume. And we can see the option chain here is way more bullish on upsides in gold than it is for buying downside protection in gold. Now, it can get a bit messy with these metrics if we start looking at volumes and open interest changes and heat maps. But if you have the time, I would definitely suggest going into it. And importantly, looking at things like the C.O.T, the commitment of traders. Now, this shows you your palladiums, your platinums, your precious metals. We're looking at not micro gold, we're looking at just gold. Now, this is for the latest commitment of traders, and we're seeing that the open interest is 723,000, and the longs are increasing in all of the places that you want them to be increasing. In that managed money, and obviously, we're going to see swap dealers being on the other side of the trade. So obviously, their positions are going to be against what we're thinking about. But the commitment of traders report is incredibly important. But you might not like looking at that in that fashion. So you might want to look at it more pictorially, more graphically. Now, you can look at it in terms of just the raw data, in terms of the historical data. And we can see here that we are way below the actual open interest in where gold was at its highest. So that's very bullish for gold, in my opinion, because before we were seeing 266s, we were seeing 300s when gold was hitting 4,000, when it was hitting 4,500. But now we have so much room because the actual open interest and the commitment of traders, the size and the direction of the positions taken across all majorities, across all participants is only 159. Now, if we look at that in terms of an expression of a pictorial chart, we can see that we're nowhere near the lofty levels of 300 where gold was trading at 4,000, 4,500. So there's so much more rate of change. There's so much more delta in between now and where it could go, which could propel us to way higher prices in the future. Now, if you want to get more granular with your commitment of traders, you can really go into the CME, which I definitely recommend if you're a long-term holder of gold. And you can see how people are positioning each week. Now, let's look at some more data about how the flows, the capital flows and ETFs and central banks and who's buying. So as we can see that for the majority of the time, it was not the Americans who were the most bullish. The Europeans were outpacing the Americans in terms of their bullishness. The Asians were consistently bullish, but now we're starting to see that American bid, that North American bid in terms of tonnage, and that North American bid in terms of actual dollar flows. Weekly, we can see it as the Americans coming into it, but yearly, we can see that the Americans are really picking up their buying power. The Europeans are really picking up their allocation to the precious metal. And here are the raw numbers of it as well. Now, we can see here which countries are increasing their demand, increasing their tonnage, and some countries are selling as well. But the buyers are outpacing the sellers. And all of our ETF, the top 10 fund flows, all going up, demand going up each week, each month, each year, as you would expect in a roaring bull market for gold. Now, if we go back to the charts, I think it's important for us to stay focused on the technicals. Price action tells you everything you need to know in this market, I would believe, and looking at the corollaries, which are the other precious metals as well. But I think if we are to start managing the risk around this, we want to maybe start looking at the options market as well. So let's look at the options chains. Let's look at the option market and let's see how that's all behaving in terms of GLD and SLV and futures prices as well. So let me pause for now. And in my next video, we're going to be looking at how option markets are pricing in the future of gold. I hope you've enjoyed this. If you have, give me a share, give me a like, give me a subscribe. I always like to see feedback on my charts and on my trading as well. I don't normally talk about charts, but I think I'm going to be talking about charts a lot more. About the patterns of charts, about how we can trade them, and how we can look at lower lows, momentum, higher highs, news flows. So if you found some value at this, like, share, and subscribe, and I'll catch you in the next time. Ciao for now.